Okay, so it looks like we're live. I'm going to give you the ability to share your screen. So welcome everyone. This is the Bullish Stock Institute's webinar on stock options. And your host is Ken Blanks Harrell. Welcome.
Appreciate it.
I should have wrote a little script, but
it's all good. You know.
Oh, good Lord. Sorry.
Sound like my puppy. I just had to put her up. Isn't here fighting. So you want me to go ahead and get it started, ma'am?
Yes, thank you.
All right, awesome. Let me make sure. First and foremost, want to make sure that everyone can see and hear me clearly. For those of you who are tapped in via Zoom, if you could just put the number 1 in the chat box, and then I'll know that you can properly see and hear me. That'll let me know that you can see. And if you'll see, Deb, I'm trying to connect with my phone too, just as a backup. So if you can let me in. But yeah, if y'all hear me, see the screen, everything, thank you for tapping the 1. And that will be primarily how we communicate. If you have any questions, put them in the chat. That helps for us to keep with the flow. Devin, if you see questions, if you don't mind, just holler them out to me as they arise. I'm very confident there'll be a bunch of questions. This is a new subject for most. And just before I get started, I want to give the little house cleaning disclaimer. I'm not providing stock market trading advice. I'm not going to be here to tell you to buy or not to buy something. That's not what my role or desire is to do. I'm not a stockbroker, so I don't manage people's money. I'm never going to ask you to cut me a check and help you make no money. That's not what I do. You handle your own money, all right? I'm not a financial planner nor an advisor. I'm just someone who has some experience, and I'm just having a conversation, right? We're going to have an open conversation. I'm going to teach you some key concepts and things that you need, but I'm not here to make any plans of what to do with you or your family's money. I'm not responsible for your money. You are. We're here for educational and informational purposes only. At times, entertainment purposes if any of my jokes go over well. All right, so this is the disclaimer. All right, the format. This is not a cookie cutter system for investment education. This is your training. You get out of it what you put into it. I'm going to give you a verbal homework assignment due weekly because this is a 3-part series. Well, not due weekly, it's due monthly, actually. So it's a 3-part series with the Pontiac Public Library. You will be able to be quizzed on lessons randomly. So you can be as interactive and participate as much as you like. You will have access to record this session on your device. I believe that the library is recorded. If not, then you can raise your hand and we should be able to give you the permission to record it on your own device. All right. If you,
the library is recording.
Awesome. Even better. Gotta love it. So library is recording it. So you be on the lookout for a link at a later time to tap in. In order to get my seal of approval, you have to demonstrate your knowledge to me, because I will be your coach through these 3 months. And then you'll also have the opportunity to ask a ton of questions, and questions are not limited to these sessions. You will have the ability to tap in with me between sessions. All right. At no additional charge. You'll be able to tap into me, after this session. So, all right. So I'm going to give you the quick agenda, what you can expect this month, next month, and in our 3rd month together. And we're going to jump into it. Today, we're going to go over a brief history of stock options, the mechanics of stock options, how options work, why people trade them, and what is moneyness. And I'm going to also wrap up with how to read an options chain. So this is going to be a pretty meaty sandwich that we're going to eat today. So I hope that you're ready, got your thinking caps on, pad and pen to take some notes. And of course, we're going to make sure we wrap up with a QA session. Next month, when we get together, we're going to discuss the homework assignment. And then we're going to also do what's called Meet the Options Greeks. I'm going to teach you how to buy options and how to win. I'm going to teach you how to sell options and how to win. And then I'm going to show you some real life trading scenarios from one of my trading accounts. And then also a QA session. And then in our final gathering, We're going to discuss the homework from the prior month, and I'm going to teach you some of the more advanced tactics like how to roll options, how to trade spreads. I'm going to show you some of the stocks and ETFs on my personal options watch list. And then I'm going to also give you more real life trading scenarios from one of my active trading accounts. And of course, wrap it up with a QA session. So you're in for a treat. Options is something that can unlock a whole new world to you from an investment standpoint. So I encourage you all to tap in. The question in the chat from Stephanie about the slides. The slides are available through the video link that will be provided by the library. So everything that's on my screen, everything you hear from my voice is all interwoven into the Zoom recording. So you'll be able to see the slides, pause it if you want, review. And then what some people also do is they just take screenshots, because I pretty much talk for a few minutes on every slide that I post. So please do not hesitate to take a screenshot of anything that just impulses you, moves you, that you want to do some further studying on it this weekend. That being said, I'm just jump right into it. I'm going to pause before I jump into. I'm going to stop my video just because I don't want to mess up the bandwidth, because my video is on in with the screen share. So I don't want you to get choppy recording of me. So you should still see my screen. Stock options history. Stock options history. All right. Stock options started back in 1973. They were standardized by the Chicago Board Options Exchange, or the CBOE. Okay. Okay. And then also in that same year, you have the Options Clearing Corporation, the OCC, who also started in 1973. Okay. It was only 16 products, and you can only do call options only. So it's grown exponentially since then. In 1975, they allowed put options to be offered. And then years later, the S&P 500 index options were offered in 1983. Just going over some of the milestone years. 2005 is when weekly options were offered. When they first started, options were only available on a monthly basis. So just in more recent times, you can do weekly options, which a lot of people do. And today it's grown from 16 products to over 5,000 products and billions of dollars traded in the options market. All right. I show you this to know the options market is a whole different world and universe. It's not NASDAQ. It's not the New York Stock Exchange. It's not even stocks. Stock options aren't stocks. So just want to give you a little bit of history of how it works. One thing to keep in mind is the OCC, the Clearance Corporation. They are the clearinghouse to make sure that all options contracts go through. They have never had a mistake, a hiccup, erroneous transaction. It has never happened, not one time since 1973. So options is more of a secure, certain type of marketplace than the traditional stock market. A little more complicated to navigate, but very valuable. So let's get into this, the mechanics of stock options. This is arguably going to be one of the most important slides I show you today, because if you don't get this, it's going to be challenging to get options. All right. So we need to load the mechanics of stock options. So every word on this screen I'm going to go through, and I want to make sure that you have an understanding of how they work, because they're all interwoven and they're all very important in order for you to know how to properly do stock options. Okay. So the first thing I need to teach you all is about the concept of what's called derivatives. Derivatives. All right. The word derivatives are an asset class. All right. Which basically means that the value of a derivative instrument does not come from within itself. Right. The price of gold is based on the gold itself, because gold by itself is worth something, right? Silver by itself is worth something, copper, aluminum. These tangible things have a certain value already within them. Whereas a stock option, unlike a piece of gold, does not. A stock option in and of itself has no value, right? Its value comes from somewhere else, meaning If the value comes from somewhere else, that means its value is derived from somewhere else. So the value of an options contract is based on the performance of a company's stock. So the best way of explaining this is the value of a stock price is based on the performance of a company. If a company does good, whatever good is, then usually the stock price will do good. If a company does bad, whatever bad is, then that means usually, not a guarantee, but usually if a company does bad, then its stock will also do bad. Okay. On the flip of that, so that means that the stock price is attached to the company's performance. The stock options price is not attached to the company's performance. The stock options price is attached to the performance of the company's stock, right? So if a company's stock goes up or does good, then usually the option contract does good. And if the company's stock does bad, then usually the options stock does bad because the value is derived from another source. We'll get deeper into the derivatives as we move along. The most important connection is understanding the underlying asset. Every option is a derivative and its value is derived, comes from an underlying asset. What is that underlying asset? Usually it's a stock or an ETF or an index fund. That's what the underlying asset is for a stock option. The next word is contract. I highlighted it in gold because essentially that's all an option is. A stock is represents a piece of ownership in a publicly traded company. That is not what an option is. That's what a stock is. An option is merely a contract. That's all it is. An option is not an equitable stake in any company. An option is a contract. An option is sort of like a side bet. If you ever seen people in TV, movies, or in real life at the casino or the dice table or something, the people holding the dice, throwing the dice, those are stockholders. Those are people that own stock. The people in the options market are the ones side betting. That's all options are, side bets, right? They're contracts. And like any contract, I think the best example I could use is maybe like a real estate contract. If you ever bought a house, you use a contract, what is called a purchase agreement, right? Because a contract is an agreement between two parties. Those two parties are a buyer and a seller. That's what a contract is. And like a purchase agreement, a stock option contract has an expiration date. This is very critical, an expiration date. Stocks don't have any expiration dates. Stocks can go on forever. The only time stocks expire is if they go bankrupt. Otherwise, stocks keep going. Companies keep going. Walt Disney, the man, been left this planet Earth. Walt Disney, the company, is still a-rolling, worth hundreds of billions of dollars and more, and keeps growing. Even though we as people expire, stocks don't unless they go bankrupt. Options, though, they expire like people quicker, right? Options expire anywhere from, you can have an option expire weekly, and options can go all the way out to about 2 years. And options that go out beyond 6 months are called leaps. Those are long-term options. 6 months to 2 years are called leaps. And then other than that, you have regular weekly and monthly options. I mentioned to you earlier that options expired once a month back in the day. All options expire on Fridays. Back in the day, the once a month options all expire on the third Friday of the month, which is known as Options Friday. Now, some options are traded, a lot of options are traded weekly, which means they expire every Friday. All options expire on Fridays. The third Friday of the month is known as Options Friday for the monthly expiration cycles. And all other companies that do have options traded against them, they expire on a weekly basis. That's typically based on things like volume. If there's a whole lot of volume, a whole lot of interest in a company, then you'll typically see that they have option contracts that expire every single Friday. Okay, so you have an expiration date. Just like if you were buying a house on that purchase agreement, you only have so much time to actually buy the house, right? It's usually somewhere like between 30 and 60 days. Nobody really gives you 6 months to figure it out, right? If you want to buy the house, here's the down payment, get your money together, and then boom, right? It's other things you need to do, get it inspected, get it insured, get some things done. But if you're up against the clock, you're on the clock. The same thing applies with trading stock options. You're on the clock. All right. The strike price is the agreed upon price in which this contract will transact. If it was a home on your purchase agreement, that strike price we call it the purchase price. What is the agreed upon price that you'll purchase this home? Same thing with the options contract. It's called the strike price. It's not a purchase price in options. It's a strike price. But it's still, what is the mutually agreed upon price that this contract will transact? In the options world, you pay what's called a premium. If you want to be in the contract, you put down some money. That money is called the premium. And you pay the premium, then you can buy an options contract. In the case of a real estate transaction, it'd be the down payment, right? That's what makes it stick, or earnest money deposit. Some people do EMD. So they say, hey, I want to buy your house. I want to buy it for XYZ amount of dollars. I think I can close within 30 days. And here's a check, a certified money order for $2,500. So you know I'm serious. And I need you to take your house off the market and let me get time to come up with the rest of the money. Right. And if they blow the deal, they lose their earnest money deposit or something like that. They lose that premium because they lock somebody up. Same thing with the options world. If the deal don't go through to your favor, all you can lose is that premium. Exercise when you exercise your right. That means you take advantage of the options contract. You execute on whatever your contract says you can do, right? Like the purchase agreement. If you buy the house and actually show up and buy it, that was you exercising, right? Exercising your right to buy that house. And then the assignment part would be the seller of the house. They're fulfilling their obligation. That's what assignment is. Assignment is fulfilling the obligation attached to assignment is the obligation attached to that other end of that contract. All right. So exercise versus assignment. We're going to go much deeper into this as we keep rolling. Okay. But I just wanted to get you guys started and knowing these are the terms that are critical and key, or you won't understand options. All right. So options is a contract whose value is derived from an underlying asset. That underlying asset is typically a stock, an ETF, or an index fund. All options expire on Friday. If they're monthly options, they expire on the third Friday of the month, which is known as Options Friday. Otherwise, they expire on any Friday, every Friday. All options have agreed upon transaction price, known as the strike price. You pay a premium in order to seal the deal. Buyers pay premium and sellers accept the premiums. Buyers buy the right to exercise their options contract, and sellers get assigned on contracts at the buyer's choice. Let's keep on moving. How stock options work. Again, you got buyers and sellers that come together and make a contract. And then they have, so the buyer and the sellers, you pick a side. Which side are you on of the transaction? Are you buying or are you on the seller side? So after you pick your side of the transaction, those terms are called long or short. People who buy options are considered long in their position, and people who are sell options are considered short in their position. Okay, so buyers versus sellers are the sides. Long versus short is the position. All right, and now we're going to talk about rights versus obligations. Okay, so people who buy options are buying the right to either buy or sell shares. Okay, people who sell options are taking on obligations to either buy or sell shares. Okay, that's how that works. We're going to go much deeper into rights versus obligations. And then we all know of these two terms, calls versus puts. Okay, calls versus puts. We heard about it all the time. A lot of beginners throw those out there and don't really know what they mean. Within a few minutes, you'll know exactly what they mean. Calls versus puts are basically directions, right? Which direction are you going in with the trade? So calls and puts are pretty much like the same. It's like driving on one street, but just different directions. Like being on Telegraph. You can go northbound or southbound, but either side of that road, the speed limit is 50, right? So just look at that concept. Calls and puts aren't anything other than the opposite side of directions of the same street. And you can make money whether the underlying assets go up or go down or remain flat, as long as you're right. All right. Why do people trade stock options? I want to take a temperature for participation. Put in the chat room, put in the chat box. If you know, if you're on Zoom, put in the chat. Give me a reason. Why do people trade stock options? Somebody put that in the chat for me. Anyone. Why do people trade stock options? There's two major reasons I'm looking for. But let's go on ahead and put in the chat. What do we have? Okay, Devin said to make money. That's a start. Jatuan said they can make major gains. Less daily monitoring, Stephanie. Okay. All those things can happen. I'm going to tell you the number one reason is called leverage. The number one reason why people trade stock options is because of leverage. Because you can put out a little bit of money and make a lot more on it than what you put out. So I know I used the example earlier of real estate, and I want to stick with that example to make this concept easy to understand. Let's say you were a cash buyer of a home. Let's say you didn't have good credit and no job. All you got is some cash, right? And let's say the house for sale that you want to buy is $150,000. Well, guess what? You're a cash buyer. That means you need $150,000 to buy that house. Now, let's say you don't have $150,000. Let's say you only got $15,000. Well, if you're a cash buyer and you go buy a house for $15,000, the house you buy for $15,000, I mean, it may not have any windows or doors. If it certainly probably don't have no hot water tank or no furnace, they already broke in and took that. A house that costs 15 grand is probably not much of a house at all. Not to offend anyone who may live in a $15,000 house, but if you bought a house with 15 grand cash and you're talking about moving in, I doubt it's move-in ready. Now, if you have a job or income, whether it's W-2s, 1099s, you got some tax returns and good credit and some cash reserves, and if you get an inspection and an appraiser and insurance, then yeah, you can take your 15 grand and probably go move into a house that costs 150. Why? Because of the power of leverage. The bank will loan you the rest of the money. They'll loan you the other 135 grand. Just because you got good credit and can prove other things and you saved up some money. The power of stock options is you get the same type of leverage as you do with real estate, except you don't have to have a job. You don't have to have no credit report. You don't need an inspector. You don't need insurance. You don't need none of that. All you need to do is have a desire to want to participate in this game. And that's why the options world has been one of the best kept secrets, because it's you can get the same participation in the move as if you own the stock without ever having to own the stock. So you come out of less money and you can make more, just like with real estate. The other reason people love stock options is because of what's called leverage. I'm not leverage, but risk management. You lower your downside. All you can stand to lose is your premium. If you bought $10,000 worth of stock, in theory, that company could go bankrupt and you can lose your $10,000 or your $1,000 or your $100. Whatever it is, you could lose if you buy stock. Some people got out there a few weeks ago and was messing with that AMC and that GameStop and bought at the wrong time and lost a bunch of money chasing these stocks, right? But if you bought options on all that stuff, all you could lose is whatever you paid for the option. You can't lose all your money. You can only lose whatever you paid for the option. So you have impeccable risk management to your downside. So it puts you more in control. So you get the upside potential, you got the power of leverage, and then on the downside, you have the strength of mitigating your risk. So far, so good. We're going to keep moving. Got a video that's going to help explain some of this.
So you just bought your dream car. You buy a brand new Maserati. And to protect your new Maserati, you need insurance. So you go to Flo from Progressive and you purchase insurance. This financially protects your new Maserati in case you get into a crash. And this is the exact same concept as options. Now, instead of a car enthusiast, let's say you're an investor and you just bought $12,500 worth of Apple stock. That's $12,500 in risk. Now, just like the Maserati, you can buy insurance on your investment. This is called a put option. So if you buy an option, then someone had to have sold it to you. But who? The answer is any other trader who is willing to be paid to take on your risk, just like an insurance provider. That's the basic idea of options. An investor has risk, but he's willing to pay someone to take away his risk. And the person who gets paid now assumes his risk. Now let's look at a real example. You bought 100 shares of Apple stock at $125 per share. This cost you $12,500. And you also buy a put option as insurance for, let's say, $500. Now, I'm going to give you two different scenarios. In the first scenario, after you own the stock and the option, the stock ends up going to $132 per share. So you made $700 on the stock, but you paid $500 for an option that now has no value to you. So your net profit is $200. Now, you might be saying, what a ripoff. And the person who sold you the option is saying, thanks for the easy money. But let's look at a different scenario. This time, Apple's stock price drops to $113 per share. And your stock is now worth $1,200 less than you paid for it. But thankfully, you bought this option as insurance. You go to the person who sold you the option and you say, hey, remember our contract? You can exercise your option you bought, and even though Apple is at $113, you can immediately sell your shares at $125 per share. So now your only loss is the money you paid for the option, which is $500, much better than the $1,200 loss you would have had if you did not purchase the option. Now, the person who sold you the option was obligated to buy your stock from you at $125 per share. So they kept the $500 you paid them for the option, but they are now sitting on a $1,200 loss on the stock they own. They can hold the stock and hope it goes back up, or they can sell it at the current market price of $113 for a net loss of $700. Now, the cool thing about options is that you don't have to own stock to trade them, and they aren't actually physical pieces of paper. It's all done virtually. You can trade them in and out of the market within a few milliseconds at the click of your mouse.
All right, so let's get to the nuts and bolts of this thing. There are only 4 trades, right? You can buy a call or you can sell a call, right? You can buy a call, you can sell a call. If you buy a call, you make money when the underlying goes up. If you sell a call, you make money when the underlying goes down. All right, that's the call side. On the put side, it's the opposite sides of the streets, right? So if you make money buying a call, then you don't make money buying a put. You make money selling a put, right? You sell a put, you make money if the underlying goes up if you sell a put. Just like you make money if the underlying goes up if you buy a call. Buy a call, you make money if the underlying is bullish. You sell a put, you also make money if the underlying is bullish. You buy a put, you only make money when the price goes down. All right? Because you're buying that insurance protection. Right? So if you bought car insurance and you don't get in an accident, you just waste the money on premium. You get in an accident and you got to go to the flow and she make you whole again. And that was the value of a put, of buying it. All right. Flow sells puts. She makes money if you don't get in an accident. She makes money if you're a safe driver. She loses money if you get into car accidents. All right. So there's only 4 trades. You can buy a call, sell a call, or you can sell a put or buy a put. So this particular screen, and feel free to screenshot this, but this brings the whole thing all together. This is the whole concept on one screen of the stock options process. All right. This is the whole thing. A buyer and seller come together and they make an agreement. That agreement is a contract. That contract is known as a stock option. That contract has a set price, which is known as the strike price. All options contracts have an expiration date, which we know is either every Friday or the third Friday of the month. And there's two types of options. To address the question that was just asked in the chat, I believe that question was asked by Jatwan. And that's what's a call and a put. A call option is an options contract that you can either buy or sell. If you are if you're buying a call, if the price of the underlying asset goes up, the value of your call option goes up. If the underlying goes down, your call options value also goes down. If you're on the put side, it's the opposite side of the street. If you own a put, if the price of the underlying asset drops, your put becomes more valuable. And if the underlying goes up, your put becomes less valuable. All right. Someone, and feel free again to screenshot this if you like. Somebody says options the same as shorting. No, the word short is used, but it's not the same. Shorting is different. When you short a stock, that's like borrowing shares from the broker and immediately selling those shares in the open market and then going back and trying to buy them back at a lower price at a future date. So shorting is what kind of happened with that AMC and GameStop stuff. And that's called a short squeeze, when there wasn't enough shares out there for somebody to come in and replace. So shorting is done on stocks. You can't short options, but you can short stocks. All right. Options, again, you don't hold the dice, you side bet. So these are different rules of options. Outcomes. This is very important to know. What are the outcomes? When people play this options game, how do they typically get out of the game? See, it's easy to get yourself into trouble. I want to help y'all get out of the trouble, right? So now you tied up in the options, how to typically shake out. And I'm gonna round the numbers, but basically 70% of the time people flip their option to somebody else. They'll go buy an option. Maybe they say they buy a call. They'll buy a call because they think the price of a stock is going to go up. And 70% of the time, people flip that call to somebody else on the options market before it expires and sells it at a profit. 70% of the time, that's how people exit. They buy something for low, they'll buy $200 worth of options, and they sell them to somebody else for $300. And then they wash, rinse, and repeat. You know, they might buy it for $300 and sell it for $600. Some people buy them for $500 and sell them for $1,500. You just never know. Or maybe you took a loss. I don't want to just paint the picture you only make money. What if you spent $300 on the option and you was wrong and now it's down to $150, but at least you can sell it and keep half your money and live to fight another day. You don't have to lose all of your money. Losing all of your money is a choice. Losing all of your money in options is optional, no pun intended. Losing some money on Wall Street is part of the game, but losing all your money, that's a personal choice. You don't have to sit there and watch none of your positions go to zero. Because you can clearly see 70% of the time, people don't sit there and watch it go to zero. 70% of the time, people make a move. And they'll either sell it to somebody else and lock in a profit or sell it to somebody else and stop their loss. 70% of the time. 20% of the time, nothing happens. 20% of the time, the contracts ain't worth nothing. You write them, somebody buy them, and it expires worth nothing. 20% of the time that happens. All right, 20% of the time you buy a contract and it just goes to nothing, which I feel good about. It's pretty encouraging. 20% of the time you're just 100% wrong. And then the last 10%, exercise. Right, 10% of the time people actually come to the table with the rest of the cash to buy out all the options. If it was a call, you know, or 10% of the time, people who bought puts, you know, actually have to use them and exercise them. All right. It's important for y'all to kind of know that, because you don't want to go out doing something 70% of the time that the rest of the world only do 10% of the time. You know what I'm saying? Like, you don't want to be doing something half the time that most people only do 20% of the time. So you want to kind of stay within the guidelines of how it works, because this has been proven to be successful. We're going to get into how to read a quote. right? We all should know how to read a stock quote at this point. Let's look at how to read an options quote.
Options involve risk and are not suitable for all investors. Options investors may lose the entire amount of their investment in a relatively short period of time.
Today we are going to dissect a stock option quote. Stock options are contracts, and there's a lot of terms and conditions in the body of a stock option contract. And what the quote does is it actually highlights the main points of the terms and conditions of the contract. So, for example, when we look at our quote here, the first thing we see is a symbol. The symbol is XYZ. Now, that's going to represent the underlying stock symbol. So it might be Amazon, General Electric, Nike, but most option contracts represent 100 shares of stock. So in our example, we're talking about 100 shares of our made-up stock XYZ. Now, next to that, we have a date. As with all contracts in general, they usually have an expiration date, and that's very true in the stock option world. Our expiration date is December 17th, 2017. After that day, this contract ceases to exist. You can no longer trade it on any exchange. So with stock options, you have many different expirations to choose from. They can go for as little as a few days out to as long as a few years in time. So the next thing we look at, we actually see a strike price, and then we see a type. Now, as far as the options are concerned, the strike price goes hand in hand with the type. So in our instance, our strike price is 70. This is the price at which the underlying stock will be traded at if the buyer exercises their right. Now, if they'll be buying or selling depends on the type. In our instance, we have a call option. That means that the owner of the contract will have the right to buy 100 shares of stock at a strike price of 70. And hence the term call means that we can call stock away from somebody. If this was a put option, you would have the right to sell 100 shares at that strike price of 70. And the reason why it's called a put is because you are putting stock to somebody at that price. So lastly, we get to the most important part of the quote, the actual cost to buy the contract. In the options world, that cost is often referred to as the premium of the option contract. Now, we know this option contract represents 100 shares, and this quote is priced on that 100 shares. That means that if we see it $3.10, we need to multiply it by 100 to get the total cost of the option contract. And in this instance, it would be $310, and don't forget commissions whenever you're trading options. So, bottom line is, when we look at an option quote, it tells us a lot about the terms and conditions of the contract very quickly. We know that in our quote, we're talking about 100 shares of XYZ. The expiration date is December 2017. We have a right to buy that underlying because we're buying a call. The price that we'd be buying it at is $70, and the total cost is $310 plus commission. So that's it for this episode. I look forward to your questions and comments below. And in the meantime, may all the options that you buy finish in the money and all the ones that you sold finish out. Until next time.
Brian Overby is a senior options analyst over at Ally Bank, and he has a book that I bought called The Stock Options Playbook, and it has 40 diagrams of different options setups and the break even and why you should use them and the risk to reward ratio. It's called The Stock Options Playbook by Brian Overby. So you may want to add that to your reading list. Let's see. We got a question here from Jatan. Says, as beginners, should we focus on buying and selling calls? Jatan, that's a great question. I say, yeah. I think it's easier to stay on the call side as beginners. As we move through with your training and as you move through with your own experience, if you get more comfortable with call, after you've shown some kind of level of mastery with the calls, then I like to see you go to puts. I don't really like for people to do them both at the same time, especially with this being brand new knowledge. It's easy to get confused. But if I can teach you how to drive from Detroit to Pontiac If I can get you there to go northbound on Telegraph, I can teach you all the speed traps and the what lights you can and can't. You know what I'm saying? I can teach you all the ways to get you from the south to the north. Then I can teach you how to get from Pontiac back to Detroit. But right now, I'm trying to teach everybody how to get from Detroit to Pontiac, and Pontiac is our destination. All right, so I think that that's calls. All right, let's move forward. So this is a screenshot taken from Yahoo Finance, right? Yahoo Finance. If you go and look up any company, in this particular instance, I looked up AT&T's AT&T's options. All right. I went to Yahoo Finance. I typed the letter T into the box because T is the ticker symbol for AT&T. And when I came to the screen, if you look at the tabs to the right, it'll say options. And I clicked options, and this shows me the options chain. We're going to go through this top to bottom, left to right, make sure we know what we're looking at. So I highlighted in yellow. You see it says calls. I looked at what are the July 16th, 2021 calls, right? So, 5 months from now, essentially, what's the price going to be of AT&T contracts? If you remember from the video, he said, may all the options you buy finish in the money and all that you sell finish out the money. Moneyness is part of the game. ITM, ATM, OTM. In the money, at the money, out the money. If you see here, the in the money strikes are blue, highlighted is shaded blue. In the money means that when you're buying calls, in the money means that you're buying the option strike price at a price that's lower than the market price. So at the time of taking this screenshot, AT&T stock was between $28 and $29 a share, where you see the ATM black arrow, right? You see that's the line where the blue separates from the white. So just call it, it could have been $28.50. Let's say AT&T stock is currently $28.50. Well, if you bought a strike all the way down to 20, that's deep in the money. But if you bought a strike that say 35, that's out the money. See OTM, right? And see all that red to the right of it, all that stuff, because that's out the money, right? Meaning that's less likely to be profitable for you, right? What's most likely to be profitable for you is the stuff in the shaded blue, what's in the money. In the money is talking about intrinsic value and moneyness. But before we dump in all that, let's just make sure we know what we're looking at on the screen. There's a whole lot of stuff on the screen. So the first thing you see under the yellow part that's highlighted says calls, it says contract name. From the last video, that's what you'll see. So like if we were looking at, say, the $24 strike price, right? And strike is the blue number that says 24. It's in the middle. And then you see all that T21076, all that stuff at the beginning for the contract name. Well, that's simply saying T for AT&T stock. 21 is the year. 07 is the month. 16 is the day. That's what T210716 means. AT&T stock on the year 21 in July on the 16th day. The letter C means it's a call. All right. They all have the 000, and then you got the 24 for the $24. That's what we read. And then when it says last trade date, we can see on the 24 strike on February 5th at 3:22 p.m. is the last time someone bought that contract. You see the strike price says $24. Last price says $4.85. Last price. Last price is the premium that the last person paid for that contract. So the last person paid $4.85 for that contract. Remember, every options contract represents 100 shares of stock. So we paid $485 for that contract. We paid $4.85 for the right, but not the obligation to purchase 100 shares of AT&T stock for $24 per share on or before July 16th, 2021. Did everybody follow that? If you did, let me get some feedback in the chat room. If you followed that, push the number 1 in the chat. If you're with me so far to this point. I don't want to lose nobody and go too fast. Only one person with me? Jatan sees 15 for the first contract. Yes, that's the 15 would be the strike price. but you would pay $13.70 in premium for it, right? Because that's the last price for the contract, which means you would be paying $1,370 for the right, but not the obligation to buy 100 shares of AT&T for $15 per share on or before July 16th, 2021. And we know that July 16th is what day of the week? First person put in the chat. What day of the week is July 16th, 2021 without looking at the calendar? We already know. There's options. It's a Friday for sure. Because all options expire on Fridays. All right, so we got all the way through. We know contract, we know in the money, at the money, out the money. We know contract name, last trade date, strike price, and last price. Last price is the premium. Yes, Jatan, you right on it. The last price is the premium price that you pay for the options. And it'll look the same whether you're looking at calls or puts. And we're going to look at puts next. I just want y'all to understand these calls. So the next column says bid. Bid is how much somebody is willing to pay for that contract right now. That's the bid price. So typically you're going to see the bid price is usually the same or less than the last price or the ask price, right? Because sellers always want more for it and buyers always want to pay less. That's with anything, whether you're buying cars, clothes, real estate, right? Somebody that's selling something want to get as much as they can get for it, and somebody that's buying something want to pay as least as possible. And so what happens is usually that last price is right in the middle. Typically, it's between the bid and the ask. It's good to consider that because that kind of shows you the range of the premium. Change just tells you in dollars and cents how much that premium has gone up or down since the last day. Because usually the options chains are published daily. Daily. Usually the options chain typically aren't in real time. Some on some platforms are, but usually they're published daily and tell you what happened the last day. Percentage change is relevant to the change number. It's just showing you from a percentage, because some people count their numbers and their money's in dollars and cents. Some call it in percentages. As you see at the 26 strike, is up by 37 cents. But to see the comment to the right, oh, that means 11 and almost 11.5% up. That 11.5% jump may be more eye-catching to somebody just saying plus 37 cents. All right. Next column, volume. You know, is there a market for this contract? Is anyone interested? Is anyone interested in that particular contract? Okay, that's what the volume is telling you. All right, that's what that's telling you. And the bigger the volume, the better. You don't want to be caught in the mix buying contracts in an area nobody interested in. Right? You always want to make sure you have a market for it because you don't want to be stuck holding the bag. All right. Open interest. How many people have contracts open? That's all that is. Open interest. I like to look, one rule of thumb is you want to make sure there's like anywhere from 30 to 50 contracts in open interest per contract you're trying to trade. So like if you was thinking about trading 10 contracts of an option, then you want to make sure there's at least 300 to 500 open interest. You don't want to be on your own island out here. Okay, so essentially that means the higher the open interest and the higher the volume, the better. Implied volatility is extremely key because the volatility talks about how rapidly a stock price can go up or down. Right? Volatility relates to uncertainty. We don't know which way this stock gonna go. So I look for things like unusual levels of volatility and open interest and volume, like because you can kind of see through the options change where the market is at. Okay. So if you look, AT&T doesn't have a lot of implied volatility. they got it at the $15 strike, right, with that 52%. But if you look up and down the volatility on this options chain, really the rule of thumb is about 30% is, you know, is about average, 20-30% average. But you don't have no, if you even look at that 52 volatility, you talking about volume of one contract, 100, it's no action there. You can clearly, if you look at just volume and open interest alone, as it relates to July, even though you got a little bit of action at the 25 strike, most of the action is between 30 and 35 strike. You can clearly see that. If you just look at open interest and volume, most of the action on this AT&T call for July 16th is between 30 and 35. So what that makes me believe at a bird's eye view is that overall the market thinks that it's a safe bet that AT&T will be between 30 and 35 on or before July 16th, 2021. That's what it alludes to me. It's not a guarantee, but that's what that's saying. Because you can clearly see it's no interest at look at the $22 strike. Look at the $21 strike. There's no action there. There's no action there. Look at the 37 strike. Right? You can clearly see where the action is and isn't. So far, so good on looking at this options chain on the call side. Yes, no, maybe so. All right. All right, so we're gonna move on unless you guys have any questions about this particular slide. Feel free to put it in the chat or unmute your microphone.
Okay. Ken, I had a question. How do they originate? Like, who places the first contract out there? I mean, how does that work?
You saying how do?
Like, how did this even begin? I just don't understand how, you know, the contracts, like who's saying, okay, like let's say you had a brand new stock or something, and you know, how do the contracts begin? Or I guess it's like we're looking at this report from, you know, this past period, but just in the real time when people start placing contracts, is it that, I mean, like who starts this? Or is this is just something that exists for all stocks at all times?
It's a great question. So all stocks don't do what most stocks do. So let's keep it on AT&T, right? Who starts it is, there's a couple different ways to start. So let's say you own 100 shares of AT&T right now. Now, if I look up the price today, AT&T stock today is currently trading at $29.01. So call it 29. The way something like this would originate is, let's say I own, or you own, Deb, you own 100 shares of AT&T, so you got $2,900 tied up into it. Why would you buy a put? You would buy a put if you were scared that there was a chance that AT&T could go to 25 or 20, right? Maybe you don't know about this 5G rollout or whatever. You could have got some concerns, or maybe you don't like their play with the HBO Max. You got concerns. You think it may take a downtrend. Well, to protect yourself, you would buy what's called a protective put. And remember from the example earlier in the video, what you call the flow from Progressive. In case something go down and your AT&T fall, you would be better to have owned a put, because let's say you had a put at 27. That means you paid somebody else a premium, but if AT&T falls, say to 20, they would cash you out at 27. If you didn't have the put and you had the $2,900 tied up into 100 shares of AT&T, and AT&T go down to 20, well, you would lose, you know, $900, right? Because it was $2,900 today at 29, now it went to 2,000. Your 100 shares now worth $2,000. It was worth $2,900. You just lost $900. But if you bought a protective put, what if you could have paid somebody $100, and for 6 months they say, look, if AT&T fall below 27, I got you. All right, I got you. All right, so you pay 100, so that took the value of your $900 stock basically down to 28 because you paid for a protected put. But what if it actually failed to 20? You get to walk away with your $2,700 again. You're not walking away with a $900 loss. You came out of the $100 out of pocket, so you lost $100. You paid that in the premium, but now you got $2,700 back, right? So you spent $100, you got $2,700, so you took a $200 loss on your stock. But that's way all those scenarios are better. You just having $2,000 sitting around and you lost $900. You've been better off buying the put. Now on the call side, let's say you're not scared that your AT&T gonna fall to 20. Let's say you're bullish on it. You look at this and say, you know what? I think AT&T gonna go to 35, 40. You know what? You may not be the only person. If you look at the open interest in the volume, there's a lot of people that think that way too. So what's called another strategy, now you're going to get into this stuff later on, but it's called a cover call. If you own 100 shares of AT&T, you can sell somebody a options contract, which is a call. You can write the option. You can say, look, give me $100 today, and if AT&T, I'll give you the right to obligate to buy AT&T off of me for $33. Since you think it's going to be 35, 40, I give you 3 months. If AT&T move, you can buy mine off me for $33. And they paid me $100. I'm using $100 as a random number because premiums could be any number, like you see on the screen, right? Premiums from $1,370 all the way down to 3 cents, right? From $1,370 down to 3 cents. So I was using $100 as an example, but somebody could pay me $100, and I'll agree. I'll take on the obligation that I'll sell you my AT&T for $33 between now and July 16th. 2021. Give me that $100 though, or give me $200, whatever it is. Now, if they exercise their right, then they got to come and pay me my extra money, right? Because I said I was selling to them for $33, so they got to show up with $3,300 on top of the $100 they paid for premium. That don't count against. That's on top of. So it's really like buying call options. Buying options sort of like a layaway with a layaway fee. I want to buy AT&T stock off you. I don't want to pay $2,900 today for 100 shares, but I'm willing to buy yours off you for $27 a share, and I'll bring you $2,700 on or before July 2016. So let's look at the $27 strike. So I keep hollering at that $27 number. I would pay $250 today. That's what the $250 last price is. That's the premium. I pay somebody out there $250 today for the right, but not the obligation to come back later with $2,700 more to walk away with my 100 shares of AT&T. If I don't buy the AT&T and come up with that extra $2,700 on or before July 16th, I only lose the $250.
Oh, okay, that was good. Mm-hmm.
I can't lose $1 more than $250. Awesome. All right, so let's keep moving. Same stock, same expiration date, just the put side. Just the put side. One thing I want to show y'all, just take note of this. Look at how much you get. $27 call is $250. On the put side, a $27 call is $1.38. Right? Puts and calls don't cost the same for the same strike price. We're looking at the same strike price, the same exact expiration date, but it's different premiums. Because again, it's about the likelihood. If stock is in the uptrend, then the calls are going to cost more. If the stock is in the downtrend, then the puts are going to cost more. Because people are scared. You know what I mean? So it's about what trend it is as well. That affects it. But now if you look, I'm going to go back one other screen. Look at the in the money is the arrows up, at the money, arrow to the side, out the money, arrow down on the call side of things. On the put side, it's the reverse. The out of the money strike prices are and it moves with the lower pricing. And the in the money moves with the higher pricing, which is the opposite of calls. All right. So for the person that bought a put, right, for the person that has AT&T stock at 29, as you see, the deeper in the money you go, like the $35 put costs $7.15. Well, why? Because you want somebody to pay you $35 a share for something that only costs $29 today. That's why you got to pay more money, because you want somebody to make you whole at a number that's higher than the market. That's why it's in the money. You want somebody to pay you more for your car. They use a Maserati in that example, but whatever the car is, you want somebody to pay you more money for your car than you paid for it, then you have to pay a higher premium. If you got a $30,000 car and you want coverage for $20,000, that's going to be cheaper than if your car worth 30 grand and you want coverage for 50,000. You want more coverage than the actual asset is worth. You got to pay for that. And in the options market, you can. All right. Calls and puts. All right, this is important too. I want to get into this to keep us on pace. I don't want us to go too much longer. Probably got another good 15 minutes of hardcore content. And I want to make sure I can give y'all a quality QA. The future session shouldn't be as long, but it's a little challenging when you give a whole brand new subject. Liquidity and options is very important. That's why I talked to y'all about that a little bit about the volume and open interest.
Options involve risk and are not suitable for all investors. Options investors may lose the entire amount of their investment in a relatively short period of time.
Hello. Today we're going to talk about common option trading mistakes that beginning option traders make. Another common mistake that beginning option traders make is trading in illiquid option markets. Stocks have a lot more liquidity than options do. And why is that? Because when you look at the stock market, you have one stock to trade. In the options market, you have many different expirations, you have many different strike prices. So let's get a handle on exactly what liquidity means when we're talking about the stock or options marketplace. Liquidity, simply put, is all about how quickly a trader can buy or sell something without causing a significant price movement. A liquid market is one that has ready and active buyers and sellers at the current price. So if a stock is illiquid, the options are going to be. So I'm definitely not going to trade options in illiquid stocks. So let's just talk about an example. Let's look at an option contract that is trading with a bid price of $2.50 and an ask price of $3. The ask price is the price at which you can buy the stock at, and if you bought it and instantly sold that underlying, you would be selling on the bid price. And in this instance, we have a 50-cent difference between the bid and ask. Now, that's common in the options marketplace, especially if you're not trading extremely liquid stocks. So in this instance, we're talking about a 20% difference between the buy price and the sell price. So how can we trade smarter when we're thinking about option trading in general? We want to check volume and we want to check open interest on the option contracts that we're buying. Now, this is just a general rule of thumb, but if you would like at least 40 times the number of contracts you want to trade as the open interest. For example, you want to trade 10 contracts, you want to see at least open interest of 400 as far as the option strike line is concerned. Now, also, other little things you want to think about. If it's a $5 stock, a lot of times they're not very popular with options. If it's under $5, just buy the stock. Just buy the stock outright. It's a lot easier to get in and out of the stock than a very tiny or small strike option contract. And bottom line is, if you continue to trade option contracts with wide bid-ask spread, it's very hard to make up the cost of doing business. So we want to go out and look for liquid underlyings. A lot of people that will trade options will stick to 5, 6, 7 different stocks that they like to follow and they like to trade. And they're usually popular stocks, including some that are indexes like the S&P 500 index, the Dow Jones Industrial Average Index. Those type of underlyings usually have a lot of liquidity, and it takes this piece of the puzzle out of option trading. Well, that's it for today. I look forward to your questions and comments. In the meantime, may all the options you bought finish in the money and all the ones you sold finish out.
Gotta love Brian Overby. Yeah, liquidity in options is important. Liquidity in the actual underlying asset is important. You know, that's why I don't encourage students, especially new folks, get out there and mess with all them like penny stocks and stuff like that, because even though they're cheap for a reason. And most of the time they don't have no liquidity, meaning that you bought something, but you bought something you don't got nobody to sell it to, which means you'd be stuck holding the bag. So you always want to make sure there's a certain level of liquidity in the underlying and in the options, and liquidity is represented by volume and open interest. All right, so an important concept to explain. I know we spoke about moneyness earlier, at the money and in the money and out the money. So moneyness is the price of a premium, right? The price of the options premium is calculated by adding two numbers together. Those numbers are the intrinsic value and the extrinsic value. I'm going to go back a couple of slides to let's look at the put side of let's go back to the call side of AT&T. All right, so for sake of example, to use round numbers, let's say AT&T is $29. I mean, I ain't round, but rounding up. It's $29 like it is there. It's $29.1. Let's look at we looking in the money. If AT&T is 29 today, and you look at the $20 strike, the $20 strike costs $9.25. But if AT&T is worth 29, well, 29 minus 20 is $9. Well, that $9 represents the intrinsic value. The market price is 29, the strike price is 20, the difference between the two is 9. However, the premium is $9.25. So what's that extra 25 cents? That extra 25 cents is what's known as extrinsic value. Extrinsic value. If you look at the $15 strike, the $15 strike costs $13.70. If the price of the underlying today is at 29 and you subtract 15, that leaves 14. All right. So sometimes you find there's a variance. Hold on a second. I'm going the wrong direction. In those prices. So what's left over is the extrinsic value. And I got to show you how to calculate the extrinsic value, but you're going to do that next month when we go into the Greeks. I'm going to teach you how to calculate the extrinsic value, because it's called, another name for it is called the time value of the options contract, because every contract that is not expired still has value. A contract that expires 3 months from now still has 3 months of time value. So even if, so I'll go back to here, if you look at like let's look at the at the money strike, right? If the price today is 29 and you bought the 29 strike, well, that has a premium of 138. So that means there's $1.38 of extrinsic value, right? There's no intrinsic value in out of the money strike. All you could possibly be paying is extrinsic value, because it has no intrinsic value. The intrinsic value is only in the money. So for instance, if you paid for if you bought the $34 strike, it cost you 28 cents. But $34 has zero intrinsic value. It's like negative, right? It's a negative 5 points. Oh, you know what I mean? It's 5 points higher because it's out of the money. But people love to go do that because they're like, why would I pay $485 for the 24 strike when I could pay 28 cents? Well, I could pay $28 for the 34 strike. Well, the reason you only got to pay $28 for the 34 strike is because it's less likely that that's going to hit. So yeah, you don't lose a lot of money, but you're probably going to lose the money, right? You may not, you know what I mean? $28 ain't a lot of money, but you're more than likely you're going to lose. And some people load up. They be like, man, these contracts only $28. I'm going to get 10 of these. So you put up $280 for the right to buy, the right, but not the obligation to buy 1,000 shares of AT&T for $34 a share. So that's what you did. You spent $280 and you set up a contract because you want 10 contracts because one of them cost you $28. You put up 10, $280 because they so cheap. You like, man, I'm gonna get 10 contracts. Okay, so now you bought the right, but not the obligation to spend another $1,000 because every contract represents 100 shares. So you need to come up with 34 grand to cash out on these 1,000 shares of AT&T on or before July 16th. Now, granted, you don't have to exercise all of your contracts. You don't have to exercise all 10. You don't have to exercise any. You could buy one and flip 8 and let one expire. You can do whatever you want. They're your contracts up until July 16th, 2021, because then they expire. But if you actually exercise, yeah, that means you would show up with the bag for 34 grand on before July 16th. That's why you clearly see only 10% of people actually exercise. People don't be trying to come through and cash out for real. They like to play hot potato and just make money on the value of the option contract. All right. So as you see, though, moneyness has an effect. The deeper in the money you go, the more likely it is that you're going to win. Why? Well, in July 16th, let's say AT&T don't go to 34 like you thought it was. Let's say it went down to 27. It actually is 2 points lower. Well, if you bought a strike that was in the money, like a 24, that's still less than 27, so you would have won. That's why some people pay the extra money and go in the money. Because if it is a little bit of volatility, let's say implied volatility meant that the stock price can go up or down by 20%. Because we see most of them on the right-hand column in implied volatility around 20%. All right, well, 20% on a $25 strike is a $5 swing in any direction. So if you plan it at the money at 29, it can go $5 in any direction. Well, if you go $5 to the low, that makes it 24. So that's why I thought initially that was a good strike. You want to buy yourself some protection. Remember my man said, Brian Overby, you want to buy your strikes in the money, sell them out of the money. May all the ones you buy finish in, all the ones you sell finish out. So that's important. We're going to get deeper in that in the next week. But intrinsic versus extrinsic value. So this is how it works. Again, the option premium, two sides, intrinsic and time value. So we looked at the strikes that were in the money. They all had intrinsic value. In the money, intrinsic, in. And the options premium, the other side is extrinsic value, also known as the time value. For a call option, the intrinsic value equals the underlying price minus the strike price. That's the intrinsic value. If the stock price is worth 50 and your strike price is worth 40, then that call option has $10 of intrinsic value. And if that premium costs 11, then you know $1 of it is you paying for the time value or extrinsic value. If it costs 13, you know $3 of it is for the time value. The game is to pay as least time value as possible, as least extrinsic value as possible. If anything, you want to pay more extrinsic, not you want to pay more you want to pay more intrinsic, not extrinsic. And then on the put side, intrinsic value equals the strike price minus the underlying price. It's just the opposite. So all it is a swap. Remember, it's the other side of the street. I got one final video on moneyness, and we're going to wrap up this thing for a Q&A, just to help drive it all home. I love the visual aids.
When traders talk about the value of an option contract, they tend to use a common set of terms. These terms include time until expiration, time value, intrinsic value, and moneyness. Moneyness is a term to describe whether a contract is either in the money, out of the money, or at the money. A call option is said to be in the money when the future contract price is above the strike price. A call option is out of the money when the future contract price is below the strike price. For a put option, the contract is said to be in the money when the future contract price is below the strike price and out of the money when it is above the strike price. The term at the money refers to the strike that is closest to the underlying futures contract. When this happens, both the call and the put option will be at the money at the same time. The terms in the money and out of the money refer to the option contract itself and do not represent the profitability of your trade. Nor does it depend on whether you have bought or written the option. When an option is in the money, it is said to have intrinsic value and said to have no intrinsic value if it is out of the money. When an option expires out of the money, traders will say the contract has expired worthless. Intrinsic value is the value of the option if it expired at this moment. Up to this point, we described the value of an option contract at the point of expiration. But what is the value of the contract before expiration? The value of an option is comprised of two parts, the intrinsic value and the time value. When added together, they give you the option value. When an option contract expires, the time value would be 0. At this point, the option value is equal to the intrinsic value. Let's look at an example when the option has time value greater than 0. Suppose a call option will expire in 1 month. Here, the option value will be higher than the intrinsic value. Even as the futures contract price moves around, the option value will still be greater than the intrinsic value. That difference is the time value. As time moves towards expiration, the time value shrinks or decays. You can see the entire option value will always be greater than the intrinsic value until it reaches expiration. There you have it. You now know how to use terms like moneyness, time value, and intrinsic value to express the value of a put or a call option.
Yes, 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 yes. That being said, we have made it to the end. We have made it through. We have survived part 1 of stock options trading. What I want to do is open it up to a Q&A, do a brief Q&A, make sure everyone is whole and complete. I know that there's a lot of different information that we've covered today. If you need me to revisit any slides, we can revisit some slides. I probably won't play no more videos as far as on a rehash, because we do plan on getting a link from the library at a future date, so you can all, see this stuff again. So I want to go on ahead and get a QA in. If you either want to put it in the chat or you want to unmute your microphone. Let's get into it. I see Jatan asked, so the current price minus the strike equals the intrinsic value. Yes, when you're buying a call because you're bullish and you think that the stock is going to go up, and the difference between the strike and the market price. So I take like the market price, because I buy my calls in the money. So I like to make sure the market price is already above my strike, because that improves the probability of my profitability. Now, some people go out of the money. They may say, hey, the stock is 25. I'm going to buy a call at 30 because I think it's going to go to 40, right? But you could be right about direction, but wrong about the time frame. So that's the thing. Time is, if nothing else you notice, time is the elephant in the room when you trade options. Time isn't a factor like that in stocks. Right, you can buy and sell stocks, you can flip them, you can hold them long term. Like the whole thing with stocks, people say, hold them for 10 years, 20, 30 years, pass them down to your children, generations. Well, you can't pass no options down, right? Options expire every Friday or once a month on Friday, the third Friday of the month, right? Options expire, right? The longest the option goes is about 2 years. So it's always a race against time. All right. Any other questions? You guys have been great.
This is more of a comment. So the video will be on the library's Facebook page. So if you go to Facebook Watch or go to the library's page and Facebook page and click on video, it'll be with the archived webinars and
awesome
and videos. Yes, and if you ever watch on Facebook, you can put your questions in the chat on Facebook, and we will field it to the presenter, so you can still get your questions asked. So far, we don't have a question from Facebook right now.
Okay, no worries at all. Give it a moment to.
Can you all hear me?
Yes.
Okay, thank you, Ken. That was an excellent presentation.
Okay.
This is Jatan. I just had a so I'm really new to options, and I learned a lot in the presentation. I was wondering if you could go back to the AT&T list for the 16th, and yeah. So I was wondering if you could like point out maybe one of the contracts and which one you would say would actually be a good contract.
You know, it's funny you should ask that, because I don't quite think I know enough to tell you that just yet. But I think that after our next session, you would, because I actually take it one layer deeper.
Okay.
And that's what's called the Greeks. All right. And you have to learn the Greeks in order to trade options, because the only reason I say that, because the Greeks are what makes up the extrinsic value or the time value. Like right now, we know that the premium is the intrinsic plus the time value. And I think we all have a grasp of what intrinsic is. It's just taking the difference between the market price and the stock price. That's all it is, whether it's from a call or put direction, right? You either mix which one, subtracting the other, but that's all it is. The difference between the strike and the market price.
Okay, so for AT&T, the market price, I know you were saying it's like 29.01, 29.
So 29.
Okay, and then we simply subtract the last price, which is the premium, no, the strike price. Okay, yep. And so based on that, would it be the $15 one? If we just use that, would it be the contract?
You can use, like, so if you look at the 23, because again, I said assume 29 for round numbers. AT&T is probably like 28 and some change, because that's what makes the numbers make sense. 29 don't really make sense to a precision thing. But I just want to introduce y'all to a concept. Look at the 29 though.
You said look at the 23 or 29?
29. Look at 29, the number as the price today. Call 29 the market price. Oh. It just take note of that. It's not on our screen. But just saying, let's say today the price is 29.
Got you. Okay.
Well, if you look at the strike price on your screen of 23.
Okay.
Well, that costs $6. So if that was the case, that or the $22 strike would be the only ones I would buy. If I saw a situation where, because you're not gonna see it like this, but think about it.
Okay.
29 minus 22 is 7, or 29 minus 23 is 6. So I'm actually paying only for the intrinsic value, and I didn't pay for none of the time value. So I could see there, those would be the ones to get. I'm not over, you know what I'm saying? Yeah, I'm not paying no extrinsic value.
Okay, so I need to consider the current price when I'm deciding on my strike price.
Absolutely.
Okay.
Absolutely. So, let's just use round numbers. Don't look at the premiums. Just look at strikes.
Okay.
Let's say, again, let me use even round number. Let's say today's market price is 30.
Okay.
You think that AT&T is going to make a 20% swing, right?
Okay.
In the next, by July 16th. Well, a 20% swing on a $30 stock is 36. You think it's going to go to 36?
$36, right? Okay, because $6 is 20%. Okay.
You with me?
So I think it's going to $36.
That's your outlook.
Okay.
You have an outlook. You think you bullish on AT&T. You think it's going to go up. Today is 30. You think it'll be 36 on or before July 16th.
Okay.
So how do you play it? This is how I would play it. What if you are right about the direction and wrong about the percentage move?
Okay.
What if it don't move 20%? What if it only moved 10%? Does that mean it went from 30 to 33? So you was right. AT&T went up by July, but you was off by 10%, which means you will lose all your money.
Oh, okay.
Potentially, if you let it expire. Because remember, your break even is the strike, the strike price plus the premium you paid. So that's why I don't buy out of the money. I like to buy stuff in the money. Because what if you was wrong? Like I said, you thought it was going to go to 36. It only went to 33. And if you set up your whole deal based on it hitting 36 and it didn't, you blew the deal.
Okay. So
sometimes we be more aggressive in our outlook. Sometimes we think it's going to make a bigger move than it actually is going to make. So we'll learn more. That's why I can't answer your question based on the information at this level. I got to dig underneath. I got to look under the hood. Y'all know I always say you got to look under the hood and go a level deeper, peel back a layer or two, and then that'll reveal the answer to your question.
Okay.
Right? And then I can show you from a moneyness standpoint, looking at this screen, what look good, what don't look good. But I don't know from a premium standpoint. So next time we get together, we'll learn what makes up that time value.
Okay. Okay, that still helpful.
Good.
Okay.
Thank you.
So Yeah, and I have a question. So
Sure.
with the options, so do some people buy like they buy the option hoping to sell it to people who want to buy it like on sale, sort of? So like I have the option, but I don't have the stocks, but I want to sell this to someone else who definitely wants to buy it, but it's my option is cheaper than what it currently is. So they'll be able to make good on it and purchase the option and purchase the stock at a lower rate. Is that what people do?
Yeah, absolutely. People, that's the game. Buy low, sell high, just like with stocks. So people would get an options contract. Maybe you pay. So that was actually a phenomenal question. So let's look at the screen again. So let's reset and look at this screen with the calls. Okay. And right now, let's say we bought the $27 strike. So we paid $250 for that contract, right? And it's good to July. But right now, this is February 20th. Okay, so the closer we get to July, the premium is going to lose a lot of the time value. However, if AT&T stock has been making a move, right? Because we said we thought it was going to go to 36. Well, let's say it's at like 34, 35, like in June sometime. This option is going to be worth a lot of money because it's close and it's only like $1 away. And so the volatility will be there. You know what I mean? Like it's a volatility from, where your outlook was at. But if you got a $27 strike price on your contract and now it's actually get to 35, well, that's at least $8 of intrinsic value. So that means there's at least $800 per contract of real value in it that anybody would pay you for. So you literally paid something for $250, right? You paid $250 for the 27 strike. If it gets to 35 as the market price minus 27, your strike price is 8 points of intrinsic value. Every option contract through leverage represents 100 shares. 100 times that $8 spread means every option contract you bought is worth $800. So your 250 is now worth 800, which gives you a net profit of 550, right? Something you paid 250 for is now worth 8. You back out your 250, you netted 550 on or before July 16th, because you don't have to wait to expiration to sell it. You can go sell any option you buy. If you buy it, you can sell it to anybody you want, whenever you want, on or before the expiration date. If you're a buyer, whether you bought a call or a put. And if the further it moves in your direction, the further the price of the actual underlying moves in your direction, the more valuable that contract is to somebody else on the open market. And remember, 70% of the time, people sell it to someone else on the open market to close their position. All right. Hopefully that helped. I put my information in the chat for everybody, my link tree. So anyone who wants to connect can do so. Let's see. Helen asks, what does the TC0015 mean? Okay, so let's look at the very first line on the contract on this one, the T21. T means AT&T stock. So if this was Carnival Cruise Line, instead of T, it would say CCL. If this was General Motors, instead of T, it would say GM. If this was Netflix, instead of T, it would say NFLX. The first thing you see is always the ticker symbol. The next thing is the year. The year is 21. Then the next combination of 2 digits is the month, 07 for July. The next combination of 2 digits that says 16 is for the Friday that expires, which would be July 16th. Okay. The C stands for it's a call. If I hit the screen right here one time, if you see, all the C's are gone and now they're P's. So the C's are for calls and the P's are for puts. That's all that is. That's what the letter C stands for. They all follow with the 000s, as you see right here on the calls and on the puts. That's just like a space holder. So you know it's separating the difference between the two. So we then you get to the number and you ask about the 15 000. The last zero, Sophie, the last zero is always blank. And then the 1500 stands for $15. That's what it stands for.
Ken, I have another question when you come back.
Yeah, so everyone, we are, the Pontiac Public Library has sponsored 3 of these classes. So the next one will be March 20th, and then the last one will be April 17th.
Okay.
And they're always on Saturdays at 1 p.m.
Yes. And we're pretty much on time. I knew it was going to be about an hour and a half. And hopefully this was some value for you all.
It was. Can I have one more question? Is that okay?
It's up to Devin. You know, I'm with it, but you know, I'm being silly. I'm sure we can do one question.
No, yeah, one more. It's fine. We do have a story time coming up at 3, but we have room for one more here.
Okay, thank you. So the example that you just gave us, I was wondering, so is it better to give yourself more time with your contract, your expiration date out?
I do.
Okay.
I do, because what if I've been like, I got some Pfizer right now, and I was like wrong. You know what I'm saying? Like, I was right. Well, I'm just wrong on this one, but I mean, I got AT&T, some options. I'm just looking at my screen real quick because I don't win them all, right? I win a lot, but nobody's perfect. Okay, so I'm just being transparent. Let me do this. Devin, do you see me trying to tap in on the Zoom with my phone? Or is it up to me to let me in? Okay. I'm gonna do something real quick and share my screen.
Because you can execute your contract before the expiration date, right?
Yes,
okay.
I can execute. Yes, that's the power of it.
Okay.
Can you, Devin, let me share my screen with Ken's phone, the one on the bottom? Okay, but hopefully that helped.
Yes, that was really helpful, because that's what I was wondering. If the expiration dates come, then you just hit. If it's not where you need it to be, your price isn't where it needs to be. But if you have more time, then it's you have more, more time. So
that's it, exactly. So what I'm saying is this: you could be right about the play. You was right. AT&T was gonna make the move, okay, but you could be totally wrong about the time frame. You was right. Yeah, get me moved. Let's say it did move the amount of points you needed to move, but it didn't do it in time. Remember, contracts expire, so you don't get no credit for being right a month later. So I'm gonna show you one example, because it's not all winners, right?
Okay.
But here's one of my little account things. I did something with Pfizer here, because these are options. Like, so all I mostly trade options. But where is it? Pfizer, PFE. So $39 call. I bought this back in December 14th. I paid $720 for the right, but not the obligation, to buy 200 shares, because there's 2 contracts of Pfizer stock for $39 a share on or before March 19th, Friday, March 19th, because it's December 14th. I'm like, man, I know new presidential thing, the inauguration, they're gonna do X, Y, Z, ABC. It's gonna do its thing. Man, and these are the Greeks, so we gotta teach y'all that next time. So that's why you got to know that. But anyway, I spent $720. Listen, I've lost 98% on that contract. 98% of thus far. You see, the average cost, I paid $3.60, and now those contracts are worth 8 cents. Right? I paid $720 for something that was worth $16. So you don't win them all. I don't want to paint the picture of anything. Like, I'm not a stock market enthusiast, evangelist. I'm a realist. Like, you can make money, you can lose money. I do a lot of teaching out of this counsel, some stuff I get for students and stuff like that, not for them, but it's from a teacher standpoint. Like, it's like, hey, that was a good tip. Let's see how it pan out. And I put my own money up and stuff like that. But most of the options I've won on. I'd like to do a lot of covered calls. I don't have as many stocks as options. And if you notice, though, from a share standpoint, none of it's really random. Like, if you see 20s and 50s, I'm trying to accumulate. but mostly everything is in around numbers of hundreds, because if it's not worth 100 shares, at least it has no value to me because I can't do options on it.
Okay.
You see that?
Yeah.
I mean, I got to buy a couple more shares. So you see this stuff, 350. I mean, I got to get 50 more shares of that, 40 more shares of MRO, 200 shares, 200 shares. I got to get 80 more shares of Rocket. Everything is intentional. Like, I don't have 13 shares of nothing. I don't have 72 shares of nothing. I don't have 5, 6 shares. It's the intention for me is very purpose driven with this particular account, because I use this to generate weekly and monthly income, either selling covered call options or selling cash covered puts. So if you look at it in the course of the year, this account is up over 100%.
Oh, that's great.
You know what I mean?
Yeah.
So I know something. I ain't sweet, but I'm all right. And I mean, I know some people in my peer group up 300%, 400%, 500%, but I don't do a lot of the day trading, scalping, and all that risky stuff I used to do when I was younger. So I trade differently now in my 40s than I did in my 20s, but I digress. Hopefully this was of some value for you all, and I'll get more into some things to win next time we get together and teach you how to do some of this stuff.
Thank you.
Good?
Yes, thank you so much.
Much love, and thank you, Mrs. Devin B. Green, and all the great folks over at the Pontiac Public Library.